more than 50 years, real estate investment trusts, also known as REITs, have provided investors with the opportunity to invest in large-scale portfolios of income-producing real estate. Today's REITs make up a multi-billion-dollar industry, but are not without critical judgment from the public. REITs, but more specifically non-traded REITs, are often associated with high fees and limited liquidity for the investor. It was because of these negative characteristics that MVP REIT Incorporated was formed. With more than $2.5 billion in commercial real estate transactions and over 100 years of cumulative experience in the commercial real estate industry, MVP REIT's CEO Mike Shustak and his executive management team have created a non-traded REIT that is different from others. MVP REIT was formed with the belief that its distinctive investment strategy and low fee structure possess attractive characteristics not found in other commercial real estate investments. Based on current market conditions, MVP decided a significant focus of its investment strategy should provide investors with a potential inflationary hedge, potential current income, intrinsic value, and potential for capital appreciation and investment diversification. This is why MVP has placed a significant focus of its investment strategy in parking facilities, including parking lots, parking garages, and other parking structures located throughout the United States. MVP believes parking facilities provide attractive characteristics not found in other commercial real estate investments. They include generally no leasing commissions, generally no tenant improvement requirements, relatively low capital expenditures, and relatively low upfront costs and enhanced opportunity for geographic diversification. The U.S. Census shows that populations in cities and suburbs are increasing. Greater population density has the potential to increase the demand for parking. Parking properties have relatively low operating and maintenance costs. With parking, there is often not even a building to maintain at all. They generally don't require the payment of commissions to a leasing agent to help place a new tenant, and they don't require costly tenant improvements before a new tenant moves in. These low operating costs can potentially make parking properties very effective at delivering profitable cash flow. With federal budget deficits so high, many economists believe that increased inflation is a possible threat to the economy. Investors should consider investments that provide an effective hedge against inflation. Investments in real estate that combine low operating costs with short lease terms are uniquely poised to adjust quickly to changes in the rate of inflation. Parking facility rates may have the ability to rise in pace with inflation. They can react more quickly than other real estate assets, as rates can be adjusted on a monthly, weekly, or even daily basis. This is in contrast to many commercial real estate investments that may have long-term leases that limit the flexibility required to keep pace with inflation. In addition, parking facilities may provide the potential for capital appreciation. Potential capital appreciation stems from projected increases in demand. As cities continue to grow in density, the availability of land may become increasingly scarce. This may generate a heightened attraction for parking lots zoned for potential redevelopment opportunities. In other words, parking lots in busy inner cities provide developers with the option to construct alternative structures, including multifamily housing units, commercial offices, and retail outlets. As part of its investment strategy, MVP will not limit itself to a particular area or region in the U.S., but will instead seek out properties nationwide and more specifically in areas with potentially strong population growth. In 2012, the U.S. parking industry generated more than $9 billion in revenue, up from $6.9 billion just 10 years previously. This number is speculated to continue to increase as the National Parking Association believes population growth and trends of increased density in urban sectors will continue to escalate the demand for public parking. The continuation of population growth may also drive up the number of registered vehicles across the nation. Since 1990, the number of registered vehicles has climbed in both the public and private sectors. Today, there are more than 246 million registered vehicles on the road across the U.S. Even during the recent recession, the parking industry showed its ability to act as an inelastic investment. The flexibility of price fluidity doesn't just help for potential looming inflation, but also helps keep up with the changes in demand. As industry revenue continues to grow each year, so do the number of firms and establishments. According to 2008 U.S. Census data, there are more than 2,500 firms that own approximately 13,200 parking establishments. Of these firms, almost 65% run a single establishment and employ between 1 and 9 individuals, demonstrating the high fragmentation of the industry. MVP REIT Incorporated is offering up to $500 million in shares of our common stock to the public at $9 a share. We are also offering up to $50 million in shares of our common stock pursuant to our distribution reinvestment plan at an initial price of $8.73 per share. A minimum initial investment in MVP is $4,500 for a non-qualified account or $1,350 for qualified retirement plans. In order to invest in MVP REIT, an investor must make $70,000 income plus a $70,000 net worth, or have a total net worth of at least $250,000. As part of its product offering, MVP REIT currently has an annual distribution paid monthly of 6.7%. Aside from its investment strategy, MVP looks to stand out from other non-traded REITs by offering investors a product with one of the lowest fee structures in the industry. This includes 93.88% of investment proceeds available for investment, as well as 100% of potential profit going back to the investor upon liquidation. To provide the investor with a higher percentage of proceeds available for investment, while still providing the registered representative with a competitive commission schedule of 7%, MVP has decided to pay 3% from investor proceeds and 4% from the sponsor. In addition, MVP understands the importance of a liquidity event for the shareholder, which is why it has set up penalty fees to be paid by the sponsor should the REIT not liquidate by year 3. This includes 50 bips in years 4 and 5 and 25 bips in year 6. In an effort to establish itself as a key player in the non-traded REIT industry, MVP strives to provide investors with a transparent investment product and unique investment strategy that, at its core, maintains a fundamental commitment to the investor.